Michael, do you want to go ahead and get started, or are we waiting for additional people?
No, I'm ready to go if you guys are.
Okay. Great. Okay, then let's go ahead and get started, because I know we're going to kind of run short on time if we don't get it started. Well, good morning, everyone, or afternoon, sorry. My name is Trish Strahan. I'm with the Office of Statewide Health Planning and Development with the Healthcare Workforce Development Division. And on behalf of OSHPD, I'd like to welcome you to today's webinar on financial planning for primary care physicians. Please be advised that this webinar will be recorded and used for future presentations. Before we begin, I have a few things that we need to go over. As you can see on your screen, there are a few communication tools available to assist you with alerting someone if you have a comment or a question. If you have a question or a comment or you can't hear very well, please select the raise hand icon in the upper left-hand corner, which will alert me. If you're using a Mac, it is on the upper right-hand side. Please remember to click the raise hand icon again once your question or comment has been addressed, and this will clear the icon that shows up next to your name. To send a question or comment to me, please use the send note icon that is to the right of the raise hand icon, and a new window will appear, and then you can select the person you would like to send a note to. Please send any questions regarding the presentation or notes to Michael Merrill, our presenter. Time will be given during and at the end of the presentation for any questions received during the presentation. And we will be conducting this webinar with an open mic so you can ask questions throughout, but please be mindful and keep your phone muted during the presentation if you have any type of background noise that will come through and hinder other people's ability to hear the presenter. And you can do this by clicking on the mute icon at the top, and this will show a microphone with a line through it next to your name, and that will let you know that you are muted. And then to unmute yourself, just click on that icon again. I will now be turning you over to Bernice to introduce the speaker.
Hi, everybody. My name is Bernice Vega. I'm the Retention and Evaluation Activities Project Coordinator. I'm with the California AHEC, and it's my pleasure to introduce to you Michael Merrill. He's a senior partner of Infinity Group, and he entered the financial services industry in 2004 and has developed a highly specialized wealth management practice catered exclusively to helping physicians across the country to reach their goals and achieve financial independence. Michael works out of the Affinity Group in Portland and Seattle offices. However, 80% of his clients live outside of the Northwest. Michael is a regular keynote speaker at various teaching hospitals and medical groups throughout the country. He has built a reputation as an expert in financial planning for medical professionals. He strives to meet the growing demand of financial planning information within the medical community. So without further ado, Michael Merrill.
Thank you so much. I'm glad to be here today. And you know, usually when I'm giving these kind of talks to you know, an audience where you know, there's varying levels of I guess savviness when it comes to these financial topics. You know, for some of you on the line, some of this information may be a little bit over your head. For some of you, it might be a little bit basic. You know, it's hard to really cater it to be specific, you know, specifically perfect for every single person out there. So I'm going to do my best to try to strike a balance with this. By no means will you learn how to launch a space shuttle by the end of this presentation, but at the same time, it won't be, you know, super. I promise everyone will get some useful information out of this. But let's see here. Now, when I'm talking about financial planning specifically for physicians, the common question pops up of, you know, what is so unique to a physician's situation that wouldn't just be, why isn't it just financial planning in general? Why is it financial planning for physicians? Well, the first easy observation that we can make is that the income that you have the potential of earning really sets you apart from most occupations out there. Granted, there are other occupations that earn a similar, or even in some cases, a lower income than a physician. There's other unique aspects which we'll actually kind of dive here in a second, but you can see just making, over $160,000 a year puts you in that top 5% of income earners. And why that's kind of important to understand is that, a lot of the information you're going to hear out there or read, or a lot of the financial characters in the media, most of that information is really geared towards the masses because they're trying to really capture the largest audience possible. So, last time the U.S. Census data compiled the information in 2010, they found that the median household income in this country was $45,000 or somewhere very close to that. So just making, 6 figures puts you in that top 10%, i.e. most of the information that is put out there is geared towards the masses that are making about $45,000 to $50,000. Not that all of it's not going to be applicable to you, but there's going to be some things that will be slightly different. So to kind of take this a step further to kind of help identify what are the key differentiating factors, we like to break this down into what we call the 3 T's. The first T stands for time. Due to the fact that you have a much later start to the whole savings game because of the extended training years that you're putting in or that you put in, you're on average going to get anywhere from a 7 to 12 year late start on the whole savings process compared to a lot of your peers from undergrad that went straight into their careers. So with that, even though you're getting, let's say, a decade late start, shouldn't mean that your financial goals or reaching financial independence should be a decade later than most people. So due to that, we would encourage you to save a larger percentage of your income than most people. Typically, you're going to hear rules of thumb of saving anywhere from 10, maybe 15% of your income. We would encourage you to save at least 20% of your income, and we're talking about your gross income. So, if you're currently making $150,000, we would want to see you save $30,000 a year. So just keep that in mind. And excuse me. We have found that after crunching the numbers many times, we've found that if you're able to save at least 20%, you should be able to reach financial independence at a reasonable age, being that you are, getting kind of a decade late start there. So, and we'll talk more about this in a little bit. The next T stands for taxes. Due to the larger income that you have the potential of earning, you're paying a much larger tax bill than most other people. And due to that, we need to make sure that your financial plan is much more tax sensitive than other situations. And we'll talk a little bit more about that as well. The third T stands for trial attorneys, and not trying to pick on trial attorneys, but due to the initials after your name that to all of us stand for doctor, to a lot of trial attorneys, it's sue me for a lot of money. And so it's important that you've got asset protection built into the financial plan to protect you against frivolous lawsuits and that sort of thing. But now, I guess this next slide, we're going to kind of touch on 6 or 7 key bullet points that we have found to be across the board, sort of some common denominators within physicians' situations. Keep in mind that everyone's financial situation is going to be unique to you. However, we've identified some key bullet points that should apply to most people or most physicians. So I guess this first bullet point, calculate your net worth. What I mean by that is, at least on an annual basis, it's important that you're calculating your net worth so that you're able to track your financial progress over time. What is your net worth? Your net worth is your assets, what you own, minus your liabilities, what you owe, and the result is the net worth. And, a lot of times we'll see people making the mistake of tracking their net worth by how big their house is or how many cars they have in the driveway when, at the end of the day, if you own stuff, it's all kind of smoke and mirrors. So we want to make sure we're keeping an accurate count of what you own minus what you owe and actually track that over time. Now, if you're relatively new in practice and you primarily have many more liabilities than you do assets just due to the student loan debt, let's say that the result is that you have a negative net worth, which is totally common for someone who's relatively new in practice. In fact, it usually takes, close to maybe 4 to 5 years before you cross over into the positive net worth. It can happen sooner, but on average, I'd say 4 years would be kind of a typical situation. The first goal, if you do have a negative net worth, isn't necessarily to reach for the $1 million or even a positive dollar net worth. It's just to really get it to zero, where your assets equal your liabilities. We like to break this up into baby steps. And when that magical day comes, you can expect a card in the mail from us that says, "Congratulations, you're worthless," and we're going to celebrate that one with you. because it could be argued that before that you were less than worthless. But all jokes aside, a very important thing to be doing on a regular basis, once annually. You do not need a financial advisor to calculate your net worth. You can do it on the back of a napkin. So usually around tax time is a fantastic time to recalculate that, just because you have all your financial documents out anyways. The next bullet point here, match your investments to your time horizons. This is about as basic or fundamental investment advice that I can give you. One of the biggest mistakes we see people make with their investments is that they invest their long-term money way too aggressive or way too conservatively and their short-term money way too aggressively, when it should be the complete opposite of that. And typically the mindset with that is, let's say someone with retirement funds that they're not going to need to touch for 30 years, maybe invested into something conservative like a bond mutual fund or just, more of a balanced type of allocation. And usually the mentality there is, well, this is my safe money. This is my retirement money. I want to make sure it's actually there for me when I get to retirement. And, of course we want it to be there for you too, but the thing is that if you're not, well, first off, you owe it to yourself to be more aggressive with that long-term money, because if you're not, you're going to have to save usually 2 to 3 times more just to reach those same financial goals that you would have reached if you, simply invested it more aggressively. So anyways, we're not talking about riverboat gambling aggressive. We're talking about smart, calculated risk, diversifying. But and I guess what I'm referring to when I'm saying being more aggressive is to focus the majority of your, the balance of your long-term investments into equity funds, i.e. the stock market, versus utilizing more fixed income or bond funds. And then usually with the short-term cash, we find that people tend to look at that as, oh, it's just an extra $1,000 in my savings account. I'm going to roll the dice on this stock tip I got from a buddy and see if I can double my money. And if I lost it, oh well, it's just $1,000. But then come to find out it's, the last $1,000 to their name, and they have an emergency that pops up, and all of a sudden they, don't have any cash to cover that emergency. So, it's $1,000 is probably not going to ruin you in that scenario. But think of in larger terms, maybe you have $10,000 to $20,000 as your emergency fund, and you end up rolling the dice with that to see if you could double it just because you got some hot stock tip. And so anyways, bottom line, when you, first off, with emergency funds, which I'll talk about here in a little bit, it belongs nowhere near the stock market. In fact, you want to be as boring as possible with that money, keeping it in some sort of FDIC-insured account. With any additional cash that you have saved above and beyond that emergency fund, there needs to be a specific purpose for it being in cash. If there's not, we need to be investing into something more productive. But let's assume that you do have a short-term time horizon on that extra cash. Let's say it's a home down payment fund that you've been saving up, and you have 2 years before you're going to need this money. With that, we would not want to see you utilize the stock market. In that case, we would utilize either an FDIC-insured account, or the most aggressive you would be with that is utilizing some super conservative short-term bond portfolio. Utilizing some municipal bond funds within there would be not a bad idea, just because those pay tax-free interest, at least federal tax exempt. Unless you have California state-specific municipal funds, you would still owe California state tax on any of the interest. But a lot of those ones right now are yielding, a lot of the good short-term ones can yield anywhere from, 1.8 to 2.2%, and being that it's federal tax-free, it's kind of like the equivalent of earning closer to 3% in a taxable savings account. So it's a nice way to get a nice bang for your buck there. But point being is, if you have less than 5 years on that time horizon before you need the money back, it belongs nowhere near the stock market. If you have 6 years, that's not a permission slip to put it all in the stock market. That's just a permission slip to introduce the stock market to that money. So perhaps putting 10, maybe 15 or 20% in the market for something that's 6 or 7 years out, and the rest of it in something like a conservative bond fund. Point being is, the general trend should be, the shorter the time horizon, the more conservative you should be. The longer the time horizon, the much more aggressive you should be. Next bullet point here, save 20% of your income. This is what I was referring to earlier. Due to the time that you missed out on saving while you're doing your training, it's sort of time to play catch up. And with that, we want to see you save 20% of your income. What we have found is that if you can get into a habit of saving 20% of your gross income over a period of at least 20 to 25 years, we call it a 20-20 rule, which there's a number of assumptions that go into this sort of 20-20 rule, but conservatively, let's say at least 25 years of saving that 20%, we have found that you should be in a good position to stop working if you chose to, meaning you'd be financially independent. Now, it does not promise you that you would end up having, the ability to live a lavish lifestyle, buy a brand new expensive car every year. But, based on, saving that 20% for 20 to 25 years, you should be in a good position to stop working and live off at least a modest income. But then again, if you continue working, it's because you're choosing to, not because you have to. That's what this whole financial planning thing is about. It's not about, identifying an age that you want to retire factually that's 20 to 30 years away from now, because the thing is that life changes from year to year, and your values and your goals and just your priorities in life will change as time goes on. So, trying to identify an age that you want to retire when you still have 30 years before you can even touch that money, I don't think is a very good way to spend your time. Instead, what I would do is focus more so on reaching financial independence at a reasonable age, so that when you get to that point, if you continue working, it's because you're choosing to, not because you have to, giving you that freedom. The next bullet point here, eliminate bad debt. We'll talk more about that here in a little bit. Manage your risks properly. We'll talk more about as well. That's discussing sort of the insurance planning side of things. Use the tax code to your advantage. The thing about taxes is that the Congress loves to change that on us, change the tax code on us on a pretty regular basis. The current U.S. tax code is somewhere to the tune of 10,000 pages long. Unless you plan on memorizing the changes every single year, I would highly encourage you to develop a relationship with an accountant who's paid to memorize that on an annual basis. Time is a precious commodity, and I would imagine that most people would rather spend that time with their family or, working on their practice versus trying to study up on the new tax code changes. So if you don't have an accountant now and you don't know where to start, as far as looking for one, a good first step is to talk to some of your colleagues. If you're an academic-based physician, talk to some of the senior faculty members. If you're in a private practice setting, talk to some of the senior partners. Chances are they've been working with someone for quite a while, and it would be a great reference for you. Next bullet point here, review your financial situation yearly. I think this goes without saying, but I'm going to say it anyways. It's important that you're revisiting your financial plan at least annually to update it and make sure that it's on track to reach the goals that you've made. A lot of times what we'll find is people put all this time, energy, and resource into developing a financial plan. They'll set it on a bookshelf and let it collect dust for a period of 5 years and then come back to revisit it, only to find out that it's completely obsolete because life has changed on them so much and they never adjusted it. Things such as getting married, possibly a divorce, having children, buying a new house, selling a house, buying into a practice, moving cross country. From year to year, there's going to be a lot of changes that occur, so it's important that you're revisiting that plan at least on an annual basis to update that. Any questions so far? Okay. Moving along here, this next slide that you're looking at, this is what we call the pyramid of financial needs. And what this is sort of depicting is a way to prioritize your financial decisions. I like to relate this to like Maslow's hierarchy of needs, where in that pyramid, at the foundation, you sort of have food, water, and shelter is kind of like the basic necessities of life or whatnot. And within your financial plan, it's no different. You've got some basic necessities, which consist of having adequate reserves, having your debts in good order, and having the proper insurance in place. And the concept being that if you have any discrepancies in these areas, we need to address those before you get too aggressive into more long-term investing. So I'm going to spend a little bit of time talking about the bottom 3 stages here, and then we'll dive into more of the exciting world of investing after that. And let's see, go back. And maybe it's, okay. Well, the first topic we'll talk about here is, here we go, debt management. And when it comes to debt management, there's a lot of different opinions or, I guess, suggestions on how to attack your debts. I don't necessarily subscribe to any one method of paying down the debts. Instead, I like to educate folks on just really how to view your debt and let you make the decision once you're educated on really what the net effect is of those debts. So what we typically talk about is, for a moment, let's pretend that your debt is an investment. I know that it's not, but let's just pretend it is. And in your head, I want everyone on the line to imagine all the debts that you currently have, and the corresponding interest rate that you're paying for each of those debts. And whatever interest rate you're being charged on those debts, that's ultimately the guaranteed return on your money with no risk whenever you make a payment towards it or paid off, because you're freeing up that interest you would have otherwise had to pay. So for an extreme example, let's say that you have a 15% interest rate credit card. By paying that off, you're ultimately giving yourself a guaranteed 15% return with zero risk. Now, if you were to instead take that extra cash and not pay off that credit card, but instead use that money to find some investment that would yield you 15% guaranteed with no risk, you'll be looking forever because that doesn't exist. So by all means, that credit card would be the most productive place to put that money. Now, on the other hand, let's pretend that you have a 2% student loan consolidated from years ago, back when student loan rates were really nice, and you're aggressively paying down that 2% debt. By doing that, you're basically saying that there's no chance of earning higher than a 2% return long-term anywhere else. And just off the top of my head, I can think of at least a dozen places that you could be putting that money that would, should theoretically long-term produce, a higher return than just 2%. I mean, inflation in and of itself historically has averaged 3 to 4%. So utilizing some conservative inflation-protected bond portfolio would end up yielding you a higher long-term return than just that 2% interest that you're saving on that student loan by paying it off. So the point being here is that if you're not confident that you'll be able to earn a higher return long-term somewhere else versus the interest rate being charged on the debt, then by all means pay that debt down more aggressively. If you are confident that you should be able to earn a higher return somewhere else, then by all means, pay more like the minimum payments on that debt and instead invest the difference. Now, that's the mathematical or financial way of analyzing the situation. There's also the emotional side to debt where, no one likes to owe anyone anything, of course. And, no one wakes up in the morning saying, oh, gee, I'm just so pleased that I owe $200,000 to, Sally Mae for all these loans that I took out. Even if it's a 1% interest rate debt and you're losing sleep over it and it's affecting your quality of life, then by all means pay it off aggressively. Forget about the financial aspect of it and just pay it off. If you can manage to separate your emotions from your debt and look at it more, from a financial standpoint and just crunching the numbers, then great. But no right or wrong answer there. It's just more so what your tolerance is to debt. Not that anyone is super tolerant of it, but some people are able to stomach that a little bit better, knowing that it's a lower interest rate. In that case, sort of leverage that by investing that money into something that would produce a higher yield. Now, for those of you that have the bulk of your student loans at 6.8%, which really any federal loans that were taken out after, what was it, like July of 2006, I want to say, maybe it was a little bit after that, were issued at 6.8%. That's there's Perkin loans. Perkin loans are at 5%, and then Grad Plus loans, usually 7.5 to 8.5%, just kind of depending on the situation. But most folks have these loans consolidated at 6.8%. With that, because that 6.8% is kind of, well, first off, it's not low enough to ignore. It's not like a 1% interest rate debt. And it's not high enough to be super alarming. It's not that 15% interest rate credit card. It's kind of in that annoying stage or range where, it's just not pleasant to look at, but it's not super painful to look at, I guess. With that, what we typically recommend doing is setting up the payment plan on the extended standard payment schedule where you have the lowest monthly payment option, but you're making payments on it as if you were planning on paying it off within 10 years. So make it a goal to have it paid off within 10 years, but have the option to pay less if you ever have a tough month. That's the whole key with why you would set it up with that longer payment schedule, because if you have a tough month and can't make that higher payment, if you have it set it up on that 10-year plan, the bank or the lender isn't going to want excuses. They want their payment. So by being able to lower your payment to something that's half of what you're normally paying, and the bank is like, yeah, that's great. That's all that we were asking for in the first place. It sort of builds in flexibility and options within the financial plan. And the same would be true with a mortgage. If you haven't bought a house yet, if you're looking at buying one soon, we would highly encourage you to look at utilizing a 30-year mortgage, regardless of how quickly you are interested in paying off that house. There's some situations where a 15-year mortgage might make some sense, but I would say in a large majority of the situations, we usually recommend a 30-year fixed mortgage with the idea that, if you want to pay it off sooner, great. The bank's not going to turn away a check if you send in more than what's due. But if you ever have a tough month and you can't make that higher payment, in that situation, the bank doesn't want excuses. They want their money back. And if they don't receive their money, they're taking your house. So it's even less, I guess, pleasant of a situation than with the student loans. Let's see here. Any questions on debt? We got a lot of topics that we're going to be covering here, so I wanted to make sure everyone's good there. And I guess one last thing on debt, being that I was just talking about a mortgage, one of the quickest ways that you can sort of kill a financial plan or make it extremely difficult to make financial progress is to end up financing too much house and become house poor. Generally speaking, we do not want to see you finance more than roughly 2.5 to 3 times your gross annual income on that mortgage. So if you have a dual income, if your spouse has an income, combine your 2 incomes, multiply it by 2.5 to 3, and then sort of the top end range that we'd want to see you finance. Keep in mind that is a limit, not a goal to reach. A lot of times we'll run into folks and advise them on this kind of a topic, and then they'll come back and tell us the great news that they got the house and they listened to our advice and they went for financing that was 3 times their income. And it's like, well, wait a minute, no, I didn't advise you to do that. That was more so the limit. Did you look for anything any cheaper than that? And like, oh, no, I didn't. Well, the goal should be to buy the least amount of house necessary to make you happy. It shouldn't be to buy the most expensive house you can afford. So just keep that in mind. Questions at all? All righty. Let's see here. Now, the next topic here after debt management is the exciting world of emergency reserves. And with this, it's not a news flash that people need to have cash on hand for emergencies. So I'm not going to necessarily bore you with what a savings account is. I think most people get that point. They should have that there. However, what we find is that a lot of people don't end up maintaining the proper amount of cash on hand for emergencies. So we're big sticklers on this. So I'm going to talk about it anyways here. Typically speaking, we want to see you maintain 3 to 6 months of expenses in some sort of a liquid savings account. Typically you're going to find the best interest rates using an online-based bank. Bankrate.com is a great website. It's an independent consumer website where you can go and shop out all the different checking and savings accounts and what they're yielding. You can compare the fees and everything else. The key is to find one that doesn't charge you any fees, doesn't have any minimum balance requirements, and that's yielding somewhere 0.7 to 1%. Right now, that's a quote-unquote high interest. That's why we have quotations around high interest, is because there is really no high interest out there right now. But it's better than earning zero in the traditional, brick and mortar type banks that you may have a savings account set up at. But and then in addition to having this 3 to 6 month reserve set up, like I was talking about earlier, if you have a short-term time horizon of, let's say, less than 5 years, we don't want to be using the stock market. So therefore, utilizing a savings account or perhaps one of those, conservative bond funds savings, that would make a lot of sense. But yeah, it's kind of a basic area here, and I just want to at least touch on it. So let's see, there's a question here. And let's see, here we go. Question is, what type of financial professional is best to help with overall financial planning, taxes, insurance, investments? Here as for certified financial planner, good option, start with an accountant. Yep, so that's a fantastic question, Casey. Typically speaking, a comprehensive financial planner, one that not only sort of specializes in, well, I guess when you're thinking about financial planning, there's a couple different areas to it. There's the investment side of things when we're talking about the stock market. There's taxes, there's insurance, just like you mentioned here, and if you get your sole advice from an accountant, the advice is probably going to be skewed towards saving you as much on taxes today as possible, which isn't necessarily a bad thing. It's just not really taking into account every other aspect of your financial plan. If you talk to someone who's maybe more of an insurance agent or insurance-focused advisor, the recommendations are going to be skewed towards insurance products. And that's just the way that it's going to be. If you're talking to a stockbroker, the overall financial plan is going to be skewed to putting as much money as possible in the stock market, not necessarily taking into consideration an overall plan. So a professional that you would want to work with is someone who does sort of take into account these various areas into one cohesive plan. A certified financial planner, a chartered financial consultant, someone, and even if they don't have those designations, someone who sort of markets their services as comprehensive financial planning versus, insurance focused or, investing focused or whatever it might be. So doing your due diligence on when you're in the interview process and that initial meeting with that advisor, ask questions as far as what their services include, and is that something that they would provide? Like if they do sort of paint a picture of services, is that something that they would specifically provide, or is that something they outsource? Is there other partners in the firm that would handle certain aspects, or and they would only handle certain aspects? Sort of get a feel for that, and generally speaking, it's a good idea to work with someone who sort of encompasses all these different areas. But hopefully that kind of answers your question. So let's see here. Now, I guess moving along here onto the next section, the exciting world of insurance planning. The one topic I'm sure everyone was excited to hear about today. When it comes to insurance planning, there's so many different types of policies out there. If you end up owning every single one of them, you're going to become insurance poor, which is kind of silly to think about. If you don't have any insurance in place, you're 100% financially exposed, which we don't like for obvious reasons as well. Ultimately, the way we want to see you make your insurance purchasing decisions is going to be based on the cost of the risk. So if there's a risk out there that could potentially devastate your financial plan to the point of no return or make it extremely difficult to recover from, those are risks we'd rather see you share with the insurance company, transferring that risk to them and have an insurance policy. On the other hand, the risks that would be more like a speed bump along the road and set your financial plan back a few months, those are things we'd rather see you self-insure, hence that emergency reserve account we were just talking about. That's your little mini self-insurance plan. So things that you would, examples of things you would self-insure, one of them might be like short-term disability insurance. Those policies will typically pay benefits for anywhere from 3 to 6 months. If you have 3 to 6 months of cash saved up, you're able to self-insure that. It's not going to ruin your financial plan if you have a disability that lasts 3 months, if you have that 3 months of cash saved up already. Another example would be like warranties on appliances or electronics or really anything where you can purchase a warranty. Generally speaking, if you had to replace that product that you purchased the next day after you purchased it, it's not going to ruin your financial plan. Yes, it would be extremely frustrating to replace a refrigerator if you bought it yesterday and it broke and you have to buy a brand new one. In that case, it's typically covered by the manufacturer warranty within the first 12 months or whatnot. But the extended warranties that they sort of market out there, they'll typically have extensive product testing to determine the average lifespan of the products, and they'll set the warranty to expire like a day before that, and they'll try to scare you to death. It's going to break on you the second you walk out of the store. So anyways, point being is that if it doesn't ruin you, don't insure it. So if you had to replace, whether it was a TV, a refrigerator. I mean, I went to Babies R Us a year ago to buy my daughter a toy that cost $35. I can't make this story up. This actually happened. I went up to the counter to check out, and the lady asked me if I wanted to buy the protection plan for $12.99 to replace the toy if it ever broke. And I knew factually that Josie was going to break it probably within a week of me giving it to her. But there was no way that I was going to be buying insurance on a $35 item. So anyways, keep in mind, if it doesn't ruin you, do not insure it. The ones you see listed here are the ones that we do like to see eventually have, kind of going down the list here. Medical insurance, I usually don't have to convince a group of physicians that medical insurance is important. Questions on that at all? Okay, so then homeowners, car, and car insurance. Usually people get the point, when you buy a house, you have homeowners insurance. When you buy a car, you're required by law to have car insurance. Now with that, what we typically like to suggest with those policies is to make sure you have adequate underlying liability insurance for those. What I mean by that is, well, first off, car and auto and homeowners will typically have anywhere from $300,000 to $500,000 of liability coverage built into those, so that if, let's say, someone hurts themselves on their property, or you get into an auto accident and it's your fault, and let's say you're being sued, let's say the trial attorney that they hire ends up figuring out, doing some research, and figures out you have those initials after your name that stand for physician, but to them it stands for sue me for a lot of money. And let's say they sue you for $1 million and they win. In that case, your auto or homeowners would kick in and cover the first $300,000 to $500,000, and then the remaining $500,000 to $700,000 would first come out of any of your assets that aren't protected by state law, and then they would end up garnishing up to a third of your wages per year till it's paid back. It gets to be a pretty nasty situation. So the last bullet point on this page here, umbrella liability, that's a policy that you would purchase through whatever company you use for your home and auto insurance currently, and that's how you would, this is just an excess liability policy that stacks on top of the home. And you can only buy it in $1 million increments, and it will typically cost, I mean, don't hold me to this, but it would typically cost about $200 a year per million, maybe a little bit more, maybe a little bit less. But it's, you know, at least in my opinion, one of the cheapest forms of asset protection you can ever purchase. So highly encourage people, if you own a home or car, to make sure you purchase that. Now, life and disability insurance are kind of unique policies in that they're contingent upon your age and your health in order to qualify for them. Last time I checked, no one's really getting any younger or healthier, so it's usually a better idea to try to secure that sooner versus later. With life insurance, there's a number of different types of policies out there. We typically, well, I guess before we, I'm kind of skipping through here real quick. With the life insurance, there's two main categories as far as the different types. The different reasons why you would purchase life insurance, we can sort of break it down into three main categories. Number one is from a protection standpoint, i.e. if you have anyone in your life that you care about, i.e. a spouse, a child, maybe a sibling with special needs, or a parent that's depending on you economically. If anyone in your life that you care about would experience an economic hardship due to your death, that's a reason for life insurance. A second reason would be from an accumulation standpoint. You can structure a permanent life insurance policy to mirror the effects of a Roth IRA from the standpoint of the equity within the policy is able to grow tax deferred, and there are tax advantaged or tax favored ways of accessing that equity, or what's otherwise known as cash value within that policy. So it can be a very nice supplement to other things that you may be investing in for long term. It's a very sophisticated type of investment, nothing you want to move fast on. You want to do your homework and really understand what you're getting into, because there's a lot of different fees and expenses that can be built into those. It's a highly commissionable product, so the people that help you with that, they are compensated for their work through the commissions they earn. And not that I'm sure that it's not like you don't want them to be compensated for their work, but then again, there are some people that can take advantage of the situation and structure the policies to where it's much more commissionable than it should have been, i.e. that means that there's much higher expenses within your policy and less equity that's accumulating as far as, you know, the ratio of what you're putting into it versus what's actually accumulating. So anyways, move slow on that if you are considering it. The third reason is from a business standpoint. If you plan on buying into a practice at any point and needing a loan from a bank, banks require life insurance to secure the debt in case you die before the loan's paid off. You know, if you die, they don't want your business, they want their money back. So they call that collateral of assignment on the life insurance there. But anyways, the different types of policies, there's more than just two, but the two categories of coverage, there's term or temporary coverage and there's permanent coverage, which each of them have different variations of that. But the general concept is I like to relate, the comparison of term insurance versus permanent insurance kind of to the similarities of renting an apartment versus buying a house. With term insurance, it's cheaper when you're younger, cheaper when you're healthy. Well, think about, let's say, a 30-year-old that purchases a 10-year term policy. The insurance company is only on the hook for that 10 years. So the risk of that 30-year-old dying within the following 10 years is next to nothing. The probability is very, very low, so therefore the cost of the risk is cheap, and so therefore they charge you pennies on the dollar. Now, let's say that person buys that 10-year term policy, it expires, and so they apply for a new policy. They're now 40, and let's say apply for another 10 years. Well, the probability of them dying in the following 10 years is greater than it was that first 10 years, so they're going to pay a higher premium. They do that every single 10 years. By the time they get into their 60s or 70s, the cost of insurance will be cost prohibitive to the point where they're better off just not pursuing that anymore because they're not going to have money to pay bills and do anything else. So with permanent insurance, it's kind of like buying a house where early on it's going to be more than it cost you more than if you just rented an apartment. But the thing is that part of it is that you're paying yourself also. You're accumulating equity within that policy. And over your lifetime, it ends up being more of an economical decision versus if you were planning on buying term and letting it expire and then buying more term and letting it expire. Now, I'm not trying to suggest that everyone should purchase one insurance versus another. Every situation is different. It may be that for someone's situation, buying term insurance is the absolute best thing that they can do. And for someone else, permanent insurance makes a heck of a lot more sense. So if you're receiving advice from someone and they're telling you that you should always buy term and invest the difference, or you should always buy permanent insurance and never term, that's probably some bad advice. I would, look at all options available and figure out, just based on what your needs are, what is the most appropriate option. If you don't have the time to look into that stuff, but you have a need for life insurance from a protection standpoint, I'd encourage you to at least purchase some term insurance just to lock in your health. What I mean by that is when you apply for a term insurance policy, let's pretend that you're relatively healthy with no major health history. You would probably be approved with what they call a preferred health rating. With that preferred health rating, you're paying a very inexpensive rate on that coverage. Let's pretend that 9 years into this 10-year term policy, you decide it's appropriate for you to have permanent coverage. Well, guess what? Most term policies, and by most, I'd say 60 to 70% of them, will have a clause built into it that says that you're able to convert it from a term plan into a permanent plan with no medical underwriting and actually continue that same preferred health rating on the permanent policy, even if you had a change in health along the way. So as a drastic example, let's pretend that 9.5 years into this term policy out of the 10-year term, you ended up getting diagnosed with terminal cancer and you have 2 years to live. Well, you can literally fill out some paperwork in that situation, include a handwritten thank you note to the insurance company, informing them that you have 2 years to live, and without the ability to convert that plan into a permanent policy, your family would be left with nothing, and that you're thanking them very much, and just for the heck of it, you're attaching a copy of your medical records that show that you only have 2 years to live. In that situation, all that the insurance company can do is reply by saying you're welcome and prepare to pay the claim. They're contractually obligated to allow you to do that regardless of any change in health. So that's why I say if you're not sure which kind of coverage is appropriate for you, but you need some insurance, lock in some inexpensive term insurance, but do it through a company that allows you to convert it to a permanent plan without medical underwriting. Questions on life insurance? Okay. Disability insurance, I would say, is one of the most important aspects of a financial plan early on. The closer you are to reaching financial independence, the less important disability insurance becomes. If you still have, let's say, 20 years before you're thinking that you'll be in a position to stop working, disability insurance, I would argue, is one of the most important pieces of the financial plan because without your ability to earn income, there is no financial plan. I'm a little bit biased when it comes to disability insurance because it protects financial plans that I put in place. But as a physician, you should be even more biased in that that disability insurance is protecting all those years of training that you put in and all the unearned future income that's still around the corner for you to receive. And I would imagine that, even thinking conservatively, over the course of a 20-year period of time, you're looking at anywhere from 3 to 5 million of lost wages if you were to become permanently disabled at this stage. You could look at that as an asset, put that on your net worth statement, and then put a line through it. And that's what happens once you become disabled if you don't have disability insurance. So one of the misconceptions out there is that your employer would have adequate coverage to cover you in the event of a disability. And I am here to tell you that that is not true. I have never come across a scenario where 100% of your income is covered by any coverage through your employer. I've seen to where a vast majority ends up being covered, but I would say probably 85% of the time, what ends up happening is that you end up receiving a 60% benefit. I have an example up here of just using some round numbers. Let's pretend that you have a gross income monthly of $20,000 a month. Your take-home pay, let's say, is 2/3 of that, so $13,400. Well, in the event of a disability, your coverage through your employer will likely replace 60% of your gross income, so that's $12,000 a month. But because the chances are that they're paying the premium for it, you're actually going to be taxed on that because they're deducting that as a business expense. So then, therefore, Uncle Sam wants his money at some point, and they take that out of the benefit receive. So you end up netting, let's say, 2/3 of that, or $8,400. You were used to taking home $13,400, but now you're taking home $84,000. For some of you, you may think, well, shoot, that $8,400 should be adequate to cover my expenses, so why do I need any additional insurance? Well, the thing is that those benefits end when you're 65 years old. So unless you plan on dying specifically at the age of 65 in the event of a disability, or having someone else pay for your retirement, pay for your children's college, help your aging parents, take care of that sibling that maybe has some special needs, taking care of any other financial goals that you may have, then if you have all that, then sure, yeah, don't buy any additional coverage. If you're like most people and you don't have that covered by someone else, then yes, you are going to need to have additional coverage. You don't necessarily need to purchase the most expensive policy out there. Just having something that's supplemental that will sort of fill in that hole is really the key. And with that, you'd also want to make sure that attached to the policy is a clause that's commonly referred to as a future purchase option or a future increase option, which makes it to where if you ever have a situation where the employer cancels your coverage at work, because they can do that. The long-term disability insurance is not contractual. They can cancel that whenever they want to. And so if they cancel that, or maybe you change employers and they don't have any coverage, having the ability to increase your benefit on the individual plan to cover your full income is key. And I see, looks like there's a question from Tricia. Oh, got it. So we're going to sort of speed along here just for time's sake, make sure we get as much covered as possible. And I'm sure, if there's information that we don't have a chance to cover today, that we can likely schedule another session at some point here in the future and sort of wrap things up as well. So I guess the main point here is to just note to self, when you're looking at your disability insurance coverage, look to supplement it with an individual policy. And there's always a couple companies that are going to be competitive for every medical specialty, so don't think that there's just one company that's best for everyone. Now, this next slide, what to look for in a financial advisor, this is something that I think is super important for people to realize, and this goes back to, I think, a question that maybe it was Casey that asked that earlier. A couple of key things that I would encourage you to look at is, number one, that the person specializes in working with physicians. Just like there's no such thing, or at least there shouldn't be a physician on earth that claims to be an expert in literally every area of medicine. There should not be a financial advisor that claims to be an expert in literally every single type of situation. You want to work with someone who really does specialize in working with physicians that understand the challenges that you face, the changes in medicine and Medicare and everything else that's going on with the landscape of healthcare, and that really understands the career path that you're on, really how getting into medicine works, and actually exiting practice and just exiting medicine, just understanding the ins and outs of that. You also want to make sure the person is truly independent, meaning that let's say, for example, let's say that I worked for a company called Bills Financial. Bills Financial doesn't really exist, but let's just pretend that I did. Let's say I work for Bills Financial, and Bills Financial happens to have their own mutual funds, other investments, they have their own insurance products, and every single person that I sit down with, I'm going to recommend Bills products to them because that's what the big dogs are telling me to recommend to. There is a conflict of interest in that scenario. If you're working with someone who works for a company that has their own products, there is a conflict of interest. An independent financial advisor will be able to go out to the marketplace to find what's best suited for each individual that they're working with without any sort of biases or conflicts of interest. So a way to now, some advisors that are not independent might tell you that they are. And I would say don't take their word for it. at least at first until you've obviously established a good relationship with them and you know you can trust what they say or whatnot. But early on, if they say they are independent, I would still check on it. The way you check on that is going to the website you see on the screen, finra.org, and doing a broker check. When you do the broker check, you'll be able to look up basically a full profile on them to make sure that, A, there's no disciplinary actions in the past, no client complaints. You can look up what their broker-dealer's name is. The broker-dealer is going to tell you whether or not they have proprietary products. So whenever you see that broker-dealer's name, I'd type that into Google and see if it ends up that it's owned by an insurance company or they have their own mutual funds, or whatever the case might be. See here. Now, I guess kind of moving along here, knowing that we're relatively short on time, one thing that I would, I guess, sort of emphasize here is after you've got a good solid foundation to the financial plan, that's when it's time to really get aggressive with more long-term investments. The main things that I would encourage you to do is A, look for the retirement plan through your employer. If there's a matching contribution, you should at the least be contributing up to that match. To be honest, making the assumption that the physicians on the line are currently in practice and not in training, what I would probably encourage you to do is look at maximizing your contribution to that retirement plan. Right now, you can put up to $17,500 a year into a qualified plan through your employer, maxing that out. Aside from that, looking at utilizing a Roth IRA. Roth IRAs have income restrictions on them, but guess what? It doesn't matter how much money you earn, you can still get money into a Roth. And the way that you're able to do that is through what they call a Roth conversion. A Roth conversion is where you first put money into a traditional regular IRA. Normally, you would have the ability to deduct that contribution if you made under a certain amount of money. However, if you're ineligible to contribute to a Roth due to your income, you're ineligible to deduct your contribution to a traditional regular IRA. But there's no restriction on putting money into it. It's just a restriction on deducting it if you make over a certain amount. So putting a contribution into this regular non-deductible IRA and then instantly converting that into a Roth. Right now there's no income restriction on converting money into a Roth. So put, I guess simply here, Bill Gates, if he wanted to, could put money into a non-deductible IRA and convert that into a Roth IRA. It does not matter how much income you earn. So that's a way for you to between the plan at work as well as utilizing that Roth IRA, between those two alone, you're looking at roughly $23,000 of tax-deferred money. The Roth will give you 100% tax-free income in retirement. The 403B or 401K will be taxable at that stage. All the earnings in both those accounts are growing compound interest upon interest upon interest, which is really the most powerful way you can save. So utilize those buckets first if you're not filling those up. After that, that's when you would look at utilizing, non-retirement accounts, things that, accounts where you'd be subject to capital gains tax, and as well as, income tax on any of the dividends or interest that's paid out on those. But the idea is that calculate 20% of your income. That's how much should be saved. Fill up those two buckets, one at work, as well as that Roth IRA, and then beyond that, make up the difference utilizing a non-retirement account. I'm making some pretty general suggestions here that may not apply to everyone. This is just kind of at least a starting point for you to sort of kind of look into things. But I think that, and Tricia, maybe you would agree with this, that maybe at some point in the future we can maybe have another session where I could get maybe a little bit more specific on some of these different investment accounts and different methods of diversifying. It looks like time just kind of got away from us here. And to be honest, to really thoroughly sort of get through the rest of the information, it'd probably be another 30 to 40 minutes. So I don't know if that would be okay with you, Tricia, or...
We could go ahead and continue. I was just worried about if people are attending on their lunch hour, if they had to log off, but I think we can go ahead and continue and just go ahead and record it.
Oh, perfect. Okay. Yeah, that works. Okay. Well, then why don't I continue here?
Okay.
And please, everyone, if there's questions as we're going through this, continue to type those in, or I don't know if I should be maybe closing these out so I can see if there's anyone raising their hand. There we go. Okay. Okay. So moving along here, Now, I guess this next slide, what I wanted to do with this is sort of emphasize the importance of starting to save, sooner versus later, and not procrastinating that long-term savings. And with this example, we're using some relatively, I would say, relatively modest numbers in this comparison to really kind of drive home the point or have people really grasp the concept here. If we used larger numbers, it'd be a little bit less, realistic to believe or kind of look into. So just follow me on this one. So let's pretend that someone is saving $2,000 a year from the age of 35 to 45, and at that time they stop saving, and they're going to look at taking money out of this account once they reach the age of 65. During this time frame, from the time they started investing all the way to age 65, we're assuming an 8% return on their investments per year. At the age of 65, this person ends up with almost $150,000 in this account. Not a bad investment whatsoever. $20,000 turns into $147. That's great. Well, on the other hand, let's say that this person delayed that savings by 10 years. And so now they're 45 years old when they start to save, and they're going to actually save twice as much. They're going to still save $2,000 a year, but they're going to save it for twice as long. So now this person's saving $40,000, but waited 10 years to start saving that. Assuming the same rate of return, this money ends up growing to $114,000. Now, I mean, it's kind of, I guess, $2,000 a year for most physicians. That's how much you need to be saving at a minimum per month. So, think about it as far as how that would really be affected if we were showing numbers that was, $2,000 a month for that 10 years versus, $2,000 a month for the 20 years, and kind of what that difference would actually look like. It's a pretty staggering number when you actually run it with those larger ones. So, anyways, the longer you wait to start saving, the more it's going to cost you in the end. Is kind of the method here, or the lesson. When it comes to long-term investing, we like to diversify our money in a matter of 3 different ways. And normally when people are thinking of diversifying their financial plan or the long-term assets, they tend to think of the first category, asset class diversification, which I think generally speaking people think of like, let's make sure we don't put all of our money in one stock. Let's make sure that we don't put all of our eggs in one basket and sort of spread that out. And that's certainly an important aspect of diversifying, but it's not the whole picture. Time horizon diversification and tax treatment are also very important, and we're going to sort of touch on each of those. Starting with asset class, however, so the slide you're looking at, it may be a little bit fuzzy on your end, but just work with me on this. So what you're looking at, this is what's called a Callum periodic table of investment returns. And what it does is it shows a timeline from 1991 all the way up to 2010, and it lists each different colored block represents a different index that you can invest into. And it ranks them from top performers all the way down to the worst performer for each year during this 20 years. So the first easy observation to make when you're looking at this is that there's no pattern that develops when looking at this as far as predicting what's going to do best from year to year. It's kind of a random mess. So therefore, the easy conclusion to make would be, let's spread our money out amongst each of these asset classes to make sure that we're always exposed to whatever's doing best from year to year versus trying to predict what's doing best. And most people would acknowledge that as common sense is something that would be a prudent way to approach this. However, what we find is that people end up investing based on what we call the asset class du jour, or in other words, whatever is doing great in the recent past. A good example of that today would be gold. I'm sure that a lot of people have heard commercials about gold doing very well in the recent past, and I'm not trying to pick on gold. It's just kind of what's highly talked about at this stage right now. It was real estate back in the mid-2000s, tech stocks in the late 90s. There's always going to be another asset class bubble that's going on that everyone thinks is the next best thing since sliced bread. Well, when it comes to gold, there's a commercial that I hear coming into work periodically that talks about how gold has appreciated 500% over the last decade, and due to that, in and of itself, everyone that has their money invested into stocks needs to sell everything they have in stock and put it all into gold, just simply because gold is up 500%. Now, to me, that's kind of like the equivalent of a friend calling me up this morning saying, hey, Mike, guess what? Gas prices just went up 500% overnight. It's a great time to fill up our gas tanks. Oh, yeah, let's get some gas for our neighbors while we're at it. Of course, that doesn't make much sense. However, people, for whatever reason, do not translate that same concept into their own investments. I guess even giving you another simple example of that is, let's say today a Diet Coke will cost you $1. Tomorrow it will cost you $5. The question is, when is it a better time to buy that Diet Coke, today or tomorrow? I think everyone would agree, today. So the point being is that when an asset class has rapidly appreciated, there's anything that's happened in the past has zero relevance to future returns. That is something that a lot of times people mistake. They look at something like gold that has had this long track record of the last, well, I wouldn't say super long, but the last decade of being up 500%, and they see that as something that's going to continue to increase at that pace, and that there's very little risk involved. And at the end of the day, because it's increased 500%, guess what? The risk has increased 500% as well, because now you have a higher chance of it coming back down. So there is no such thing as the perfect investment. Anything that's up now might be down tomorrow. There's nothing that tells us historically, just due to the way that X performed last year, that Y is going to perform this next year. And so to really prove that point, with this 20-year time horizon here, there's actually, let's pretend that you had $10,000 to be investing each year during this 20 years, and you're going to be placing that $10,000 each year into the asset class or index that was the best performer from the previous year. So on January 1st of 1992, let's pretend that you put that $10,000 into the Russell 2000 Growth. That was the previous year top performer. And then January 1st of 93, you put it into the Russell 2000 Value, and you do that every single year for that 20 years. At the end of that 20 years, that $200,000 investment grows to roughly $400,000. I might be off by a couple thousand, but it's roughly $400,000 is what that $200,000 grows to. That assumes you didn't sell anything along the way as it lost value. And then let's say in another example, you take that same $10,000 and instead of chasing the returns, you chase the negatives, meaning you invest in whatever the worst performing asset class was from the previous year. So in 1992, January 1st, you invest into the international index because that was the worst performer from the previous year. You do that every year for that 20 years. At the end of those 20 years, that $200,000 investment grows to roughly $440,000 versus the $400,000 that the best performers ended up resulting in. So the best actually lost to the worst. Kind of counterintuitive, right? Well, there was a 20-year rolling time period just a couple of years before this where the best beat the worst by about 40 or 50 grand. There's also a 20-year rolling time period more recently where the best and the worst ended up performing about the same, almost an identical value. Basically proving that nothing that happens in the past has really any relevance on the future returns. There's nothing that predicts that. Now, let's pretend that we, instead of trying to pick and choose the different indexes or asset classes that you invest into, trying to pick the winners or losers, let's say that we instead did this crazy thing called diversify. I read it somewhere that it's a good thing. So we're going to take that $10,000 and we're going to diversify it amongst these 9 asset classes evenly. So $1,111 into each of these 9. You're going to do this every year for this 20 years. And if you think about this, the amount of stress involved with this strategy compared to the person who's trying to chase returns or worrying about what the market's doing, is it up or down, this other person doesn't care what is going on in the market. All they're doing is diversifying. They're literally doing the same thing every single year regardless of what's going on in the market. At the end of this 20 years, that even contribution to each of those 9 asset classes ends up growing to roughly $480,000. So the person that was chasing the winners for each year ended up losing the most out of all 3 scenarios. The losing asset classes came in second, and the diversified portfolio came in first. Who wins between the winners or losers each year over any rolling 20-year time period, that's going to be roughly half the time the best will beat the worst, and the other half the worst will beat the best. But in every single rolling 20-year time period, a diversified portfolio ended up beating the best and the worst. Anyways, Warren Buffett's got a great quote where he says, that kind of sums this up well. He said, the method of having a long-term diversified buy and hold strategy on your investments is the absolute worst method of investing except for every other method. And, I think what he's trying to say in there is that, of course, if you had a crystal ball that would tell us when the market's going to hit a peak or hit the bottom, yeah, great, we would just go ahead and sell the peak and buy at the bottom every time, and we end up with the best record, but we don't have that, so therefore the lesser of all their evils is to, stay invested, stay diversified, and you'll end up with the better record. In fact, people, and I guess categorize it more so as investors, actually end up underperforming their own investments by a pretty healthy margin. The S&P 500 during this 20-year time span, I believe, had an average return of like 9.5%. It might have been 9.38. Anyways, it was somewhere close to 9.5% per year for that 20 years. Now, in the same 20-year time period, the average investor in the S&P had an average annual return of 3.8% versus the 9.3 or 4% that it actually returned. The mutual fund of the decade from 2000 to 2010 had a positive annual return of 18.5%. The average investor in it was negative 11 per year, underperforming it by 29% per year for that 10 straight years. People just have this, their emotion is tied to their money. When something's doing well, they get excited, they jump on the bandwagon. As soon as it loses a little bit of value, they get scared, panic, and they sell. People are very, very good at buying high and selling low. They're not very good at buying and just holding it. The average retention rate for the S&P 500 during this 20-year time period was 3.2 years. So someone would buy it, hold it for 3.2 years, and then as soon as it lost a little bit of value, they'd sell it. And they'd wait for it to come back up before they bought into it again. And no one on the line is going to do that. I know that. I can see it now. Everyone's going to be great long-term investors. Money that goes into the market, you leave in the market. It's time in the market that produces those returns, not timing. Remember that. Questions on asset class diversification? Okay, moving on here. Here's some of those numbers that I was talking about. And actually, this is the trailing 20 years leading up to 2012. So in the previous slide, it was leading up to 2010. So anyways, pretty similar numbers. You look at the trailing 20-year return for equities or the S&P was 9.14 versus the average investor, 3.83. This one's kind of an interesting one. The average bond investor averaged 1% versus the average bond investment return was almost 7%. Bonds are about as volatile as grass growing, and still people, successfully underperform by a pretty large margin there. Bond investors didn't even keep pace with inflation, which is one of the primary purposes of investing in bonds. So, kind of interesting stuff here. There's tons of articles written on investor behavior. Feel free to, you can Google investor behavior and various things, and you'll read some pretty interesting topics, which puts in perspective on a lot of the stuff that I'm talking about here. Now, moving on to the second method of diversifying in terms of time horizon. This one isn't as lengthy of a conversation as asset class. It's still a super important one, and I've already kind of touched on this a little bit earlier in the presentation, where ultimately with your money, before you save a dollar anywhere, it's very, very crucial that you're defining the time horizon on that money before you put it anywhere. So, and usually people do a good job of that when it comes to either long or short-term money. Medium-term money, not so much, and I'll explain in a second. But typically speaking, if you put $1 into your savings account, you typically know, oh yeah, I put that there because I'm going on vacation next year and I'm trying to save up for it. Or I have a new house that we're trying to save up for to build next year, or 2 years from now. And then money that you're putting away into your retirement plan at work, you know already, hey, I can't actually get to this money until I'm 59 and a half. I'm not planning on touching this, for I guess now the next 25 years, or leading up to roughly age 60. So you're usually going to know that time horizon. With medium-term money, typically the largest medium-term goal that people end up saving for tends to be like their children's college. When your child is born, you have 18 years before they enter college. So that's not quite the super, super long-term time horizon, but definitely not short-term. So it's kind of in the middle. You'll typically have more of a balanced approach with that kind of a time horizon. Typically, you might have 60 to 70% in equities or in the stock market, and another 30 to 40% in something fixed with that kind of a time horizon. Typically, when you're looking at north of a 20 to 25 year time horizon, you're going to want to be focused, a little bit, much more towards the equity side of things. But the shorter that time horizon gets on that goal, the less you're going to want to be exposed to that. But just making sure you've got the various buckets set up to satisfy the different time horizons on your money is the main thing with this. Moving on to the third method of diversifying, the exciting role of taxes. Now, let's see here. So we were feeling a little bit witty when we were putting together this presentation, so we threw this slide in, and it's kind of interesting. What do you get when you combine the words "the IRS"? It's not a brain buster, but it's theirs. Yeah. So I think there's kind of a conspiracy going on here. But anyways, when it comes to taxes, or I guess your financial plan, aside from inflation, taxes are going to be your financial plan's greatest enemy. So it's important that we're minimizing that tax liability as much as possible between now and the day you retire, during your accumulation years, as well as during the distribution years from the day you retire to the day you die. And so with that, I want to give you a quick history lesson on the tax rates in our country. And so the graph you're looking at, this is the top tax rate in our country for federal taxes ever since 1913, when they first implemented income tax. Back then, the top rate was 7%. Today, and this slide's a little bit outdated, but today the top rate is 39.6%. You can see it's been everywhere in between, ever since then. What this graph does not show you is how much you have to be earning to be taxed at those particular rates, and it doesn't tell you what any of the other rates are. It's just simply showing you what the top rate is. So now, if we look back to our history, the top rate back in the 50s was 92%. That was taxed on any earnings over roughly $400,000 back then. Now, adjust that for inflation and take into account the actual percentage of the population that earned that much back then. It's kind of like the equivalent of someone who earns, $5 million a year today. So it didn't really affect that many people. But if you imagine if you earned $500,000 a year back then, the last fifth of the year that you worked, you only took home $8,000 of that. So at that point, what the heck is the point in working that last fifth of the year? But you can see, we had a nice little break in the tax code there, and then they kind of stuck it to us there, and then we move on down to the early 80s, and we had a situation where the top rate dropped down to 50%. Holy smokes, that's fantastic compared to what it was previous to that. But here's the thing: is that the 50% was taxed on any earnings over roughly $86,000 or $87,000. Adjust that for inflation, it's like the equivalent of anywhere from say $170,000 to $200,000 today. So you can imagine that, so compare that to today, where the top rate is at the 39.6. But if you're making $200,000 right now, that top, anything you make, slightly over $200,000 right now is taxed at like a 33% rate. So compared to back in the early 80s, we can, and really any time before that, dating back to the 20s, tax rates today are actually still at a relatively low point. Compared to where they were. In the mid or late 80s, the top rate was 28%. That's fantastic compared to 50, right? And it was great for higher income earners. However, for the lower income earners and the middle class, it was still a relatively high tax situation, because this 28% was taxed on any earnings over roughly $26,000 or $27,000. Roughly double that for inflation, so it's kind of equivalent of someone who makes $50,000 a year today. And now the thing about taxes is that people have the misconception that just because, let's say that you got a pay raise, and that pay raise puts you in the next tax bracket, and so all of a sudden you think to yourself, holy smokes, that means that all my income, I'm actually going to take home less money because I just moved up into the next tax bracket, and all my money's going to be taxed at this higher rate. When in reality, it's only the dollars that are in that next bracket are taxed at that rate. So, for example, in 2011, the top rate was 35% taxed on any earnings over roughly $380,000. If you had taxable earnings of $400,000 back then, only that last $20,000 that you earned was taxed at 35%. The first roughly $17,000 would have been taxed at 10%. The next roughly $60,000 you earned that year would have been taxed at 15%. The next roughly $70,000 would have been taxed at 25%. The next roughly 70 would have been taxed at 28, so on and so forth. So when you actually look at the effective tax rate for someone back then who made $400,000, it was about 28%. The whole purpose in me giving you this tax history lesson is to really point out the fact that not only are the tax rates unpredictable, but so is the income you have to be earning to be taxed at them. And so because we don't know what that's going to look like, over the next 20, 30, 40, 50 years, it's important that we're diversifying the tax treatment of your investments to make sure that you're able to hedge against those different tax changes. So with that, there's three main buckets that can be utilized from a tax standpoint. Generally speaking, these are kind of the three major tax bucket or different buckets that can be used, and I'll kind of walk you through each of these. So pre-tax retirement plans, those most people should be familiar with. That's the equivalent of the retirement plan you'd have through your employer. So if you're working for an academic institution, you're probably going to have a 403b. If it's a nonprofit private hospital, it's 403b as well. If it's a for-profit hospital system, it's a 401k. Generally speaking, those are going to be the major pre-tax plans that you'll have. And with that, it's the money that goes into it, you're basically telling Uncle Sam, hey, I'm going to give you your share of this eventually, but just not right now. When I get to retirement and I start taking money out, that's when I'll go ahead and pay you. But right now, I'm going straight from my employer into this plan and not paying tax on that money quite yet. The money that you put into there, you then have invested into various investments, various mutual funds that you select. The money grows tax deferred. All the investment earnings grow compound interest upon interest upon interest, and when you get to retirement, any of the dollars you pull out at that stage is taxable income to you at that time. You don't have to pull it all out at once. You draw it out in even distribution over the following 20, 30 years. You can roll it all over into an IRA. There's a lot of different things you can do there. Now, post-tax plans are kind of the opposite, where you're telling Uncle Sam, hey, I'm willing to pay you your share right now of this, but then you're never getting another penny of this ever again. So the Roth IRA concept or post-tax concept is that the money has already been taxed and it's never taxed again. It grows tax deferred, and when you get to retirement, you can pull that money out 100% tax-free. Sounds pretty good, right? Now, the last bucket there, capital gains tax, this is if you were to utilize a non-retirement account, which is just a investment account that you would be able to access whenever you want to. Let's say you wanted to invest into stock XYZ and you didn't want to use an IRA or any other retirement account to do it. You wanted to put the money in there and then sell it and take the money out if you wanted to and not have any restrictions. That would be a non-retirement account or a non-qualified account. And generally speaking, the majority of the taxes in there, if you have the portfolio structure to be much more tax sensitive, the majority of the tax that you'll pay in there would be capital gains tax. There'll be some dividend income tax that you pay along the way as well, but for the most part, capital gains tax would be the major part of that. Historically, capital gain rates have hovered between 15 and 35% throughout history. There's currently three tax rates for capital gains. There's a 0% rate, a 15% rate, and a 20% rate. The 0% rate is taxed, not taxed for people who make under the 25% tax bracket. If you're in the 10 or 15% brackets, you don't pay a capital gain tax currently. If you're between that 25 and basically like the top tax rate, you're going to pay a 15% rate, and anything above that, you end up paying 20%. So for the vast majority of people, you're going to pay 15% currently, and the higher income earners will pay 20%. Now, if you think about this, the capital gains tax isn't necessarily taxed on the investments just because it's grown. It's only taxed when you realize the gain. So let's say you invested $10,000 into stock XYZ and it grew to $20,000. You're not going to pay capital gains tax as it's accumulating while you have not sold it. If you still own it and you have some gains in there, you're not paying a capital gains tax on it. It's only when you realize the gain, i.e. sell it for a profit, is when you'll pay a capital gains tax on that gain. So if you invested 10 and it's worth 20,000 and you sell it, you'll pay that 15%, let's say, tax on the 10,000 of growth. So anyways, I guess now that you have an idea of what these different buckets do, let's imagine a scenario where you're in retirement and income tax rates are through the roof, they're super high, but capital gain taxes are super low. Well, in that case, you would just delay or defer taking money out of the pre-tax accounts and instead utilize the post-tax and capital gains buckets. But then, and that's assuming the capital gain rates are super low at that stage. And then let's pretend that capital gain rates, it flip-flops to where capital gain rates are really high, but income rates are really low. In that case, we would delay taking money out of the capital gains tax buckets and utilize the pre- and post-tax accounts as your income. And then let's say another scenario occurs where both income taxes and capital gain taxes end up going through the roof. They're super high. Well, you still have your good pal here, post-tax, which gives you 100% tax-free income. So really, regardless of the tax situation they throw at you, as long as you have these 3 buckets set up, you're really able to bob and weave with those tax changes and minimize that tax liability as much as possible. Questions? Comments? Alrighty, moving along here. So, let's see. I guess kind of some main differences between like the typical pre-tax plans versus the Roth IRA. We already kind of talked about this, but just I guess as kind of a refresher, the Roth IRA concept utilizes after-tax money, tax-deferred growth, and the tax-free distributions, whereas the 403b, 401k concept is pre-tax, tax-deductible or whatnot. Money grows tax-deferred, but eventually you're going to pay your share of the taxes when you start to pull that money out. Now, one of the things I was talking about earlier was the idea of doing a Roth conversion to still utilize Roth IRA even though your income may push you out of being able to do a direct contribution. Well, the same is true for any pre-tax money that you have from an old employer or just an old IRA rollover. What you can do if you wanted to get more money into a Roth is you can convert any old retirement plan that you're no longer participating in or any traditional IRA that you've got that's pre-tax, you can convert that into a Roth IRA. The only thing is that any pre-tax money that you then convert into a Roth, it has to be taxed that year because you're going from a pre-tax plan to a post-tax plan, so you have to make that money now post-tax, i.e. pay tax on it. When you do that conversion, you're usually offered the option to withhold taxes on that conversion so you don't have to worry about paying the tax bill at the end of the year. Well, if you do that, they will treat it as an early distribution and penalize you on whatever you withheld. So they actually give you this, it's like, oh, hey, do you want to withhold taxes? And you're like, oh, sure, why not? And like, aha, gotcha, now we're going to penalize you 10% on that too. So the point being is do not withhold taxes when you do those conversions. Unless, if you do it, make sure you're fully aware of the fact that it will be penalized as an early distribution if you're under the age of 59 and a half. If you do it, or if you make that conversion and you do not withhold the taxes, that means that whatever the balance of that conversion was, that's what will be counted as income that year for you. So add that to your income, and that's you may end up owing an extra couple $1,000, come April 15th that following year. It might be much larger. It just depends on how much you're converting. So it's not mandatory to convert all your pre-tax plans into a Roth. It's just an option you may want to consider. If it's small enough, you might say, sure, yeah, because the tax cost may not be that much for me right now, and just get that going, pay the tax now and never have to worry about it again. Aside from that concept there, just doing that non-deductible traditional IRA contribution and converting that into your Roth each year is definitely an advisable thing to do while that option still exists. Currently, there's no income restriction written in the tax code to convert into a Roth. So it's not like there's a current loophole. It doesn't say, oh, yeah, we're making an exception right now. It just doesn't exist in the tax code. So they would have to re-implement, with some sort of new tax legislation that particular deal that would restrict you to convert into the Roth. And right now, being that the government isn't exactly in the best financial situation, the ability to convert into a Roth does create or generate current revenue for the government, so therefore they're less likely in the short term to make any changes to that. Questions? Right. This is the income restrictions and just sort of details on the Roth IRA. If you are single and your adjusted gross or modified adjusted gross income ends up being less than $112,000, you'll be able to contribute the full amount into that Roth IRA without having to do that whole conversion piece. Once you are making north of 127 of MAGI, that is the point in which they restrict you from putting $1 straight into the Roth. You would then do that whole Roth conversion. If you make some amount in between there, you can do a modified contribution. It just depends on what you made in between. So like if you made exactly halfway between 112 to 127, so like 119,500, at that stage you would be able to put in 50% of the normal contribution because you were halfway through that phase out, if that makes sense. they adjust these phase-out ranges periodically from year to year just to sort of keep pace with inflation. You have till April 15th of every year to contribute for the previous year, so if you have not contributed for 2012 because you thought you weren't eligible due to your income, well, here's a great time to go ahead and do that. If you have questions on just logistically how that all works, feel free to shoot us an email. We're always happy to answer any questions on how you might need to set stuff up to do that. But let's see here. Just take note that the contribution went up to $5,500 for 2013. So for 2012, it is $5,000 a person. If you have a spouse that stays home, you can make a contribution for them as a spousal IRA contribution. So keep that in mind as well. And I guess with that being said, I think that concludes everything that I wanted to cover today. I guess if there's any questions that were posted that I didn't see, I can address those at this stage. Tricia, is there any way of knowing if there were any other questions or?
No, I didn't see any hands raised, and I didn't receive any notes either.
Okay. Perfect. Well, yeah, I guess thank you for having me today, and you know, if our paths cross in the future, fantastic. I'm always happy to be a resource and help out anyone that has questions on this stuff. And yeah, I guess with that being said, I'll conclude and sign off here.
Great. Well, we thank you for everybody joining us. Have a good rest of the day.
Thank you.